Hey, welcome back, subscribers, to my world of stocks. As you know, I recently put out this video here on the 5 largest purchases that BlackRock made in the most recent quarter. But while those were the 5 largest stock purchases for today's video, I actually pulled out another 3 that are still huge, billions of dollars worth in a single quarter of total purchases here. But these are also revolutionary tech stocks rather than just some typical kind of boring, finance or oil stocks or anything else like that. But these instead are, in my opinion, ones with a ton of future growth potential, revolutionary kind of products, disruptive, innovative things that they're doing. And I just think they have really interesting businesses in general. And I only own one of them myself. So 2 are actually stocks that I never even cover on the channel. So I thought it would make for a funner video to do this. I hope you enjoy it, but let's go ahead and just jump straight into it. I'll give my opinion on all 3 of them, let you know how I feel about them, and we'll kind of go from there. We'll start with the smallest purchase of the 3, and then we'll work our way up to the biggest. So even here, though, at the smallest, it was still a purchase of more than $35 million worth in the second quarter, and that was in Intuitive Surgical, ticker symbol ISRG. This is a company that is absolutely revolutionizing the medical industry with some really impressive platforms and technologies for the surgical robotics industry, already having close to 10,000 of their Da Vinci robotic surgery systems installed in 72 different countries around the world, which are sometimes worth each unit. It could be worth millions of dollars depending on the configuration. So they're pretty expensive systems. And altogether, they've actually performed more than 16 million procedures as of last year, which is likely much larger by now too, as a new one is performed every 12 seconds. That's pretty crazy. Now, the reason why this matters so much, the reason why I consider their technology to be so revolutionary for the future is because not only will their platform get better and even smarter over time, but just in general, robotic systems are absolutely the future of healthcare, especially in surgeries, where robots can execute these procedures and all kinds of other various tasks too, with just so much more precision and even efficiency, really, than a human counterpart ever could. And so if you look at this from a business or kind of investment perspective too, the other great thing about Intuitive's business model is that they're not just relying on selling these expensive machines, but rather the company is actually pulling in a whopping 84% of the revenue from recurring sales of servicing, supplies, and accessories, which has actually been increasing too year after year. And so analysts really refer to it as kind of like a razor and blade model where, yeah, you're definitely going to make a lot of money on the actual razor sales themselves. But the more important part of that business model is going to be to continue selling those higher margin blade cartridges that are specifically fitted for your razor, and that's going to ensure recurring sales where customers keep coming back for more and more every year into the long term. And so similarly, once a hospital commits such a large amount of money, again, could be millions of dollars at times for one of these, Da Vinci robot systems, well, they're really going to be locked in for years to come, not really being able to go anywhere else either for the parts and services that they're going to need for it going forward. Some of which, by the way, is some of those accessories for each procedure, it actually needs to be replaced after every procedure. So that just kind of ensures that they've got recurring sales from them. That's why the percentage is so high for that. Plus, because of our aging baby boomer population, where 1 in every 5 US citizens will be of retirement age by 2030, so too should we see a surge in demand for surgeries like colorectal, cardiac, hernia, and more. Not to mention Intuitive's Ion robots for lung procedures too, which just passed 100,000 biopsies last year. But because of all this, the company's financials have also been very strong over the years, with typical revenue growth in the double digits and sometimes even approaching 20% or more as well. And while there have been a couple of challenging years that hurt their GAAP profitability, those are mostly tied to the pandemic, which hurt hospitals, caused a lot of them to actually go bankrupt in some cases, and it just caused a lot of weaker demand from it. But going forward, EPS is actually expected to break new record highs in each of the following years as, people start going back to hospitals, which they've already done, but that's going to continue to be the case and get a lot of those procedures that they might have held off on during, the pandemic years. But because of all this, so too has the stock skyrocketed in price, and it's still up over 1,000% in the past decade. But the reason why I suspect BlackRock is actually buying the stock now is because this year actually saw a very noticeable drop in the stock price, where it lost more than a quarter of its value from the top, which I think they see as just a buying opportunity for what is otherwise, typically a high flyer. Case in point, the PEG ratio is still about 100% more expensive than the sector, but it's at least 17% lower than their 5-year average now after the drop. So again, they're basically grabbing a high-flying growth stock with impressive future tech and healthcare that, should only rise in demand long term, but for now a little bit of a lower price. And don't get me wrong, I would love to own this stock myself just, for those reasons alone. But the only reason why I don't buy in myself is because I just prefer Medtronic instead, who is not only the largest medical devices company in the world, but is also selling and developing further their own robotic systems, but with a stock price that is much cheaper, over 70% cheaper on a forward PE. And it also pays a 3% dividend on nearly 5 decades of growth. So almost dividend king status there as well, whereas IS doesn't even pay one. So I just prefer the value route on this one, but I can totally understand the growth route too, as Medtronic is much lower growth, sometimes even flat. So I think that's why investors prefer Intuitive Surgical for the growth, but some might prefer Medtronic for the value and the dividend. Okay, moving on to purchase number 2, though, we've got a much larger pickup here of more than $350 million worth. And that was in GE Aerospace, ticker symbol GE, who's actually the leftover business from a three-way split following the breakup of the legacy conglomerate General Electric, where GE Healthcare was spun out in 2023, GE Vernova can't speak today, comprising of the energy business, it spun out in 2024. And then the company that remained is GE Aerospace, which held on to the original ticker symbol of GE, with investors also getting shares of the other two companies after the split if they held on to that GE stock. Well, what is left over here, though, is what was really always their best performing, what many consider to be the most attractive part of their business, that focused primarily on engines and other aerospace technologies, much of which is absolutely considered to be revolutionary tech for the future. In fact, as we speak, GE is developing a new engine architecture called RISE, which literally stands for Revolutionary Innovation for Sustainable Engines. It's an open fan design that looks completely different from anything flying today, eliminating the traditional casings that you would typically see around engines, opting instead for exposed fan blades that can increase efficiencies by around 20% compared to even the most advanced engines of today. And given enough time, we should see Boeing and Airbus start adopting this new platform, which would obviously send revenues soaring in the future, no pun intended. But even today, GE still remains the most dominant engine provider in the space, with well over 3 billion people flying on GE technology last year, resulting in 3 out of every 4 commercial flights using their engines too. So very, a lot of exposure there, very large market share in terms of their dominance. And even aftermarket sales are even beneficial to GE too, where they may initially sell an engine for a loss, but they can later generate decades of servicing revenues as well. Plus, there's a ton of even more future potential in areas of hypersonic flight and space exploration for the very long term. For example, they've already developed new dual-mode ramjet engines that use rotating detonation combustion technology to power a hypersonic jet that can pass Mach 5 in speed, which some believe may even reach a mind-blowing Mach 10 in the future. Pretty crazy. Now, these new breakthrough propulsion systems could eventually power the next generation of hypersonic vehicles and eventually space planes too. In fact, GE is even partnering directly with NASA on what is called the High Tech Project to develop the world's first hybrid electric jet engines for commercial airliners, with plans to launch in just a couple years too. Now, for reference, the global space economy is projected to triple in size, all the way up to 1.8 trillion over the next decade. So there's just so many multiple verticals for GE to find new growth all around aerospace, both, commercially and into space and for military, for all these different purposes. There's a lot of different vectors that they can go down for growth. Now, when you look at their financials, though, they may appear to be all over the place at first glance, but it's mostly because of a number of recent challenges and transitions. For example, there were some horrible Boeing crashes and resulting groundings. There was a pandemic where travel demand completely collapsed. And then more recently, there was the split off into 3 different companies. So all those things can affect, obviously, financials. And that's why you can see several years there of some decline, some volatility. However, the more important figures are what analysts are expecting really moving forward now as this new entity, where next year, for example, they expect double-digit growth on both the top and bottom line. And as such, the stock too has outperformed, soaring by over 700% in just the past 5 years alone, which, to be honest, I'm not exactly sure if that was affected by all of the spin-offs too. But at today's higher levels, excuse me, I think I just hit the mic there, but as of today's higher levels, we're talking now about a stock price here that is about the same as it was many years ago when it was an even larger conglomerate. So the stock price has definitely soared to new highs. As for me, though, it's really the valuation that continues to scare me away as an investor, with even the most forgiving PEG ratio trading over 40% more expensive than the sector, while their PEs hover around 80 to as much as 128% higher too. So for me, that's just too rich for my blood, even though I do really like the business and I think they have a bright future, a lot of future potential with the things that they're doing, and especially as a more focused and streamlined aerospace company going forward. But again, that valuation, it just kind of holds me back a little bit. Okay. Now, while I don't currently own either of those 2 stocks myself, purchase number 3 is actually one of my favorites and largest holdings in my portfolio, and that is the e-commerce giant Amazon, ticker symbol AMZN, who BlackRock just purchased close to $2 billion worth just in the second quarter alone. And although the stock has performed incredibly well over the past few years, rising by almost 800% just in the past decade, I actually still agree strongly with BlackRock here that the stock remains a buy to this very day. And a big reason why I feel this way is in large part due to just how revolutionary this tech giant has become. The most obvious of which is in how they've been transforming the world of retail, almost single-handedly ushering in the retail apocalypse, in my opinion, because of how incredibly convenient and affordable it is to order almost any product you might need from their online store and have it delivered as soon as the very same day in some cases. Which, by the way, that e-commerce business is only getting smarter and more efficient too, with Amazon deploying over 1 million robots throughout their fulfillment centers, all coordinated by their Deep Fleet AI model that helps them identify damaged goods, sort packages, and even repair themselves too. It's pretty crazy. Which, so far, the bet appears to be paying off in a huge way for them, as their related North American segment saw operating income jump a massive 47% last quarter on just 11% revenue growth, meaning that the margins are actually improving dramatically. But on top of all that, the company has also made incredible progress on their AWS cloud platform that already commands a whopping 30% of the global cloud infrastructure market, which is nearly as much as Microsoft and Google combined. And here's why that matters so much. Well, first of all, artificial intelligence will be, worth trillions of dollars in spending every year in the future. The result of which is that every single AI company out there now needs cloud infrastructure in order to train and deploy their various AI models. Well, without a giant provider like AWS, all of these businesses would need to build out their own giant data centers at massive costs, which would completely destroy their financials at a time when all of that money really needs to be spent on their own research and development just to stay competitive in the AI field. In other words, the demand for platforms like AWS is only going to grow even larger over time from here. Hence why the segment grew sales by another 17% last quarter, with Amazon themselves committing a record $118 billion for infrastructure expansion to meet that incredible demand, while also ensuring that they remain on top well into the future. And speaking of the future, there's even a number of many other innovative bets that Amazon continues to invest heavily in for even more long-term growth, including their autonomous driving service Zoox, as well as even a new partnership with JetBlue, who's decided to now use Amazon's own network of over 100 low Earth orbit satellites for in-flight Wi-Fi, creating yet another brand new revenue stream that most people never even expected, which is what I've been telling you guys for so many years on this channel, is that while everyone continues to worry about Amazon's valuation, the company just keeps growing and expanding at incredible rates and entering brand new markets all the time that, again, many people don't even expect, don't even think of. And Amazon just jumps in, pours a giant amount of money into those new markets that very few companies can even compete with, and then they end up, usually dominating those markets too. And so they've been really expanding and growing, focusing more on the top line rather than worrying so much about current profitability, which again, I just think will come over time. But right now, you really just want to keep growing and expanding as much as you can. And that's why you see sales, total revenue quickly approaching $750 billion per year. Giant, mind-blowing amount. Nobody can even fathom that much money, and yet they're still somehow managing to grow by a double-digit rate too. So that alone makes this one of the highest priority stocks to invest in my opinion. And for me, that's exactly what this company is. That's exactly how I see them. I would rank them far and away much higher than the other two stocks on this list. But hey, that's just my opinion. What do you guys think? I'd love to hear your thoughts on all three of these revolutionary tech stocks down below. Let me know if you own any of these yourselves, and are there any other revolutionary tech stocks that you're interested in out there? Let me know down in the comment section. Maybe I can talk about them in a future video. But hey, either way, I hope you're all doing well, my friends. Hope you're all staying safe out there, and I will catch you in the next one. All right, take care, everybody. Bye-bye.